You wake up and check your bank account. The number is still there. Your dollars have not disappeared, but overnight, the world has decided it no longer wants them quite as much. Oil exporters ask to be paid in other currencies. Central banks stop adding American government bonds to their reserves. Global companies begin writing contracts in euros, yuan, or something new. And suddenly, the money in your wallet is not just money. It is a product the rest of the world is buying less of. That is what it would mean for the United States dollar to lose its global reserve status. Not that the dollar becomes worthless, not that every store rejects it, and not that the American economy collapses before breakfast. A reserve currency is simply a currency that governments, central banks, and major companies hold and use because they trust it will remain useful, liquid, and widely accepted. Liquid means easy to buy or sell without causing a huge price change. For decades, the dollar has been the closest thing the world has to financial plumbing. Countries hold dollars to stabilize their own currencies. Banks borrow dollars to finance international business. Companies price oil, metals, food, aircraft, and shipping contracts in dollars. Investors rush into United States Treasury bonds when they become afraid. A Treasury bond is an IOU issued by the American government. You lend Washington money. Washington promises to repay you with interest. Because the Treasury market is enormous and easy to trade, it gives the dollar something no competitor currently matches at the same scale. A deep pool where trillions of dollars can be parked quickly. That privilege did not appear by magic. It was built through war, institutions, markets, and trust. In 1944, while the Second World War was still raging, representatives from 44 countries met in Bretton Woods, New Hampshire. The old financial system had broken. The British pound had been the dominant international currency, but Britain was exhausted, deeply indebted, and losing economic power. The United States held much of the world's gold and possessed an enormous industrial economy. So the new system placed the dollar at its center. Other major currencies were linked to the dollar. The dollar was linked to gold at $35 per ounce. This made the dollar a kind of bridge between national currencies and the ultimate reserve asset of the time. But the arrangement contained a problem. Economist Robert Triffin explained it to the United States Congress in 1960. For the world to have enough dollars for trade and reserves, America had to send dollars abroad. That usually meant running deficits, importing more, investing overseas, or lending money to foreigners. But the more dollars America supplied, the harder it became to convince everyone that each dollar could still be exchanged for a fixed amount of gold. The system needed American deficits. Those same deficits weakened confidence in the system. This became known as the Triffin dilemma. A dilemma is a situation where solving one problem makes another problem worse. By the late 1960s, foreign governments held more dollar claims than the United States could comfortably convert into gold. Then came August 1971. President Richard Nixon suspended the dollar's convertibility into gold. This event became known as the Nixon shock. The gold bridge was gone. Logically, the dollar should have lost its central role. It did not. Why? Because reserve status depends on more than gold. It depends on habits. It depends on networks. And it depends on alternatives. If nearly every global bank uses dollars, then using dollars becomes convenient. If nearly every commodity contract uses dollars, changing currency creates new risks. If investors know they can sell Treasury bonds in seconds, those bonds remain attractive during a crisis. Economists call this a network effect. A network becomes more valuable when more people use it. A telephone is useless if you are the only person who owns one. A currency has the same problem. The euro can be large. The yuan can be important. Gold can be trusted. But replacing the dollar requires more than disliking American policy. The replacement must be easier, safer, and more useful for millions of financial transactions every day. That is a much higher bar. Still, dollar dominance has gradually eroded. International Monetary Fund reserve data show that the dollar remains the largest reserve currency by far, but its share has declined over the long run as central banks diversify. Diversification means spreading money across several assets instead of depending on only one. Some reserves have moved into euros, some into Canadian and Australian dollars, some into the Chinese yuan. Some central banks have also increased their gold holdings. This is not a sudden revolution. It is a slow leak. And slow leaks can matter. Imagine the dollar does not lose reserve status in one dramatic announcement. Imagine it loses 10 percentage points of global demand over 15 years. Central banks buy fewer Treasury bonds. Commodity producers accept more payments in other currencies. Global borrowers issue less dollar-denominated debt. International banks keep smaller dollar buffers. Each decision looks manageable. Together, they change the price of money for every American. Start with government borrowing. The United States spends more than it collects in taxes. The difference is a budget deficit. To cover it, the Treasury sells bonds. Foreign central banks, pension funds, banks, insurers, and private investors buy those bonds. Reserve status creates a huge natural audience. Some buyers want treasuries not because they love the return, but because they need safe dollar assets. If that special demand weakens, the Treasury may have to offer higher interest rates to attract buyers. Higher Treasury rates do not stay in Washington. They become the foundation under much of the financial system. Mortgage rates are influenced by government bond yields. Corporate loans are priced relative to them. Car loans, business financing, and credit card costs can all feel the pressure. So reserve status may sound like an abstract argument between central bankers, but losing it could raise the monthly payment on your house. Now, reconstruct your budget. You earn $75,000 a year. You want to buy a $350,000 home. When global demand for treasuries is strong, long-term interest rates remain lower than they otherwise might be. But after years of reserve diversification, investors demand an extra 1 percentage point to hold American debt. Your mortgage rate also rises. That 1 point can add hundreds of dollars to your monthly payment. Depending on the loan, you do not receive a letter saying, "Reserve currency adjustment." You simply discover that the house you could afford last year is now outside your budget. Then comes the exchange rate. If global demand for dollars falls, the dollar may weaken against other currencies. A weaker dollar means $1 buys fewer euros, yen, pounds, or yuan. That makes American exports cheaper for foreign buyers. A Boeing aircraft, American software subscription, or shipment of soybeans becomes less expensive abroad. Exporters may benefit. Factories that compete with imports may also benefit. This is why a weaker dollar is not automatically bad. But imports become more expensive. Phones, computers, medicine ingredients, industrial machinery, coffee, clothing, oil, depending on market conditions and how contracts evolve. Even products assembled in America often contain foreign components. A weaker currency raises their cost. That is imported inflation. Imported inflation means prices rise because foreign goods and inputs cost more in your currency. Your salary may stay the same, your shopping cart does not. The Federal Reserve then faces an ugly choice. If the weaker dollar raises inflation, the Fed may keep interest rates higher. But higher rates slow borrowing, housing, and business investment. The institution may need to protect the currency and control prices while the economy is already under stress. That is not impossible. Countries manage this conflict regularly. It is simply a conflict Americans are less accustomed to experiencing at full strength. There is also the question of financial power. When global banks move dollars through the financial system, many transactions touch American institutions. That gives the United States unusual influence over sanctions and international payments. Sanctions are restrictions designed to make it harder for a country, company, or person to access money, trade, or financial services, because the dollar is so widely used. Losing access to dollar clearing can be devastating. This power encourages some governments to seek alternatives. But here is the counterintuitive twist. Using the dollar as a weapon can strengthen the desire to escape it, while the difficulty of escaping it can demonstrate how powerful the system still is. Countries may announce new payment arrangements. They may trade more in local currencies. They may buy gold. But when a crisis arrives, private investors often still want dollars. During the 28 financial crisis, the crisis began in the United States, yet global demand for dollars surged. During the market panic of March 2020, institutions around the world scrambled for dollar funding. The Federal Reserve opened swap lines with foreign central banks. A swap line is an emergency arrangement that lets another central bank obtain dollars and lend them to banks in its own country. The world ran toward the currency at the center of the crisis. That sounds absurd. It also reveals the depth of the network. Economist Barry Eichengreen has described America's reserve currency advantage as an exorbitant privilege. The phrase is associated with French Finance Minister Valéry Giscard d'Estaing, who criticized the benefits the United States received from issuing the world's main currency. The privilege allows America to borrow in its own currency at enormous scale. Many developing countries cannot do that as easily. They borrow in dollars. If their own currency falls, their dollar debt becomes harder to repay. The United States mostly owes dollars. It can tax in dollars. It can issue bonds in dollars, and its central bank creates dollars. That does not make default or inflation impossible. It makes the structure more forgiving. If reserve status weakened, this forgiveness would shrink. American policymakers would face stronger discipline from bond markets. Large deficits could produce faster increases in borrowing costs. Political fights over budgets might move markets more violently. The country could still borrow. It would simply pay more for the privilege. Now consider the alternatives. The euro is backed by a huge economy and sophisticated markets. But Europe does not have one unified treasury market equal to the American market. Its member countries issue separate government debts with different risks. The Chinese yuan is supported by the world's second-largest national economy. But China maintains capital controls, which limit how freely money can move across its borders. Global reserve managers usually want to know that they can move large sums without sudden restrictions. Gold has no government default risk, but gold does not produce interest, is costly to store, and cannot easily support the entire system of trade credit and bank lending. Cryptocurrency can move across borders, but its volatility, regulation, custody risks, and limited role in ordinary commercial finance make it a poor replacement for central bank reserves at global scale. The likely future is therefore not one new king replacing the dollar. It is a more fragmented system. The dollar remains first. The euro handles more regional trade. The yuan expands where China is the dominant trading partner. Gold acts as political insurance. Smaller currencies take specialized roles. Digital payment networks reduce friction between them. Instead of one financial highway, the world builds several competing roads. That sounds safer. It may also be more expensive. Companies would need to manage more exchange rate risk. Banks would hold larger pools of different currencies. Contracts would become more complicated. Financial markets could become less liquid. Remember, liquidity means being able to trade quickly without moving the price too much. Fragmentation can reduce efficiency, and inefficiency has a price. This is why losing reserve status would not necessarily produce one spectacular crash. The more realistic danger is a permanent tax hidden inside the economy. Slightly higher interest rates, slightly more expensive imports, more volatile financial markets, less freedom for government spending, more frequent currency shocks. Each cost is survivable. Together, they lower living standards. But there is another side. A weaker dollar could reduce America's persistent trade deficit. American manufacturers could become more competitive. Foreign tourism to the United States could increase. Domestic production might receive a boost. The reserve roll has never been a free gift. To supply the world with safe assets and dollars, America has often consumed more than it produced and imported more than it exported. The Triffin dilemma never completely disappeared. Reserve status gives the United States cheap financing. It can also support a stronger currency that hurts some factories and exporters. Losing part of the privilege could force a painful rebalancing. Painful does not mean useless. It means the transition would create winners and losers. Exporters might celebrate. Import-dependent households might not. Debtors would hate higher rates. Savers might earn more interest. Tourism businesses could gain. Retailers selling imported goods could struggle. Wall Street would adapt. Your wallet would absorb the adjustment. So what would the end actually look like? Probably not a press conference. Probably not a new global currency appearing on Monday morning. It would look like hundreds of quiet decisions. A central bank buys more gold. An oil contract is written in yuan. A European company borrows in euros. A pension fund reduces Treasury exposure. A trading partner builds a payment system that avoids American banks. Then, one day, investors realize the dollar is no longer the automatic first choice. It is merely one strong choice among several. Your dollars would still work. Your salary would still arrive. Your grocery store would still accept the same bills. But America would have to compete for global capital in a way it has not had to compete for generations. And the next time you wake up and check your bank account, the number could still be there while the privilege behind that number is quietly disappearing.